Have you ever really thought about what happens to your money after you deposit it? It doesn't just sit in a vault somewhere. No, it enters this massive, invisible river of capital, a flow that's governed by some really old rules and some brand new technology. So today, we're going to follow that money, all the way from your local bank on Main Street into the wild future of digital currency. So here's the plan. We'll start with how fast money moves, then see how the government slammed on the brakes for a while. We'll watch what happens when those brakes come off, and then zoom in on what that all meant for small towns. After that, we'll look at the new digital wave and wrap up by asking where all this is headed.
All right, let's dive in with this one big idea. Just picture all the money in the economy as this giant, flowing river. Some parts are kind of slow and steady, but other parts, they're moving like crazy.
It seems like a pretty simple question, doesn't it? But the answer? Well, the answer is incredibly powerful. The speed at which a single dollar changes hands can tell us a whole lot about the health of the entire economy.
So economists have a term for this, of course. They call it the velocity of money. Think about it like this. You spend $1 at a coffee shop. The owner then uses that same dollar to pay their bean supplier. That supplier then uses it to buy lunch. See, that $1 is moving fast. It has a high velocity, and that's usually a sign of a really active, buzzing economy. And inside this big river, you've got these intense rapids. This is what we call hot money. It's capital that just doesn't sit still. It's constantly zipping between banks, between institutions, even between countries, always chasing that fraction of a percent higher interest rate. It's a really fast-moving and sometimes a pretty dangerous current. Okay, so to really get what's happening today, we have to go back in time, back to when that river of money completely overflowed its banks and caused a total disaster. Right after the chaos of the Great Depression, the government basically decided, okay, we need to build a dam. The whole point of the 1933 Banking Act was to stop banks from taking these insane risks just to get people's deposits. And the main tool they used to build this dam was a little rule called Regulation Q. And the change was, well, it was huge. Before Regulation Q, it was a complete free-for-all. Banks could offer whatever crazy interest rate they wanted. But afterwards, the government put a hard cap on what banks could pay you for your deposits. And get this, they made it completely illegal to pay any interest on a checking account. This basically slowed that hot money current down to a trickle. So for about 50 years, that dam held strong. But starting around the 1980s, the whole mood in politics and economics started to shift. And a whole series of new laws began to tear that dam down, piece by piece. And look, this wasn't one big explosion. It was this slow 30-year process. You can see it here. Laws in the early 80s started chipping away at all those restrictions. By 1986, the heart of the dam was pretty much gone. And then in 2011, the Dodd-Frank Act came along and removed the very last piece. And just like that, boom, the floodgates were wide open. For the first time in generations, banks could compete on interest rates again. And what did we do? We, the depositors, responded immediately. We started chasing the best rates, moving our money around for a better deal. This was the return of hot money, big time. Now, I know this all might seem like some big, abstract financial story, but the consequences, they were felt in a very real way on main streets all over America, in places just like Red Oak, Iowa. For your local community bank, this new competition started a kind of chain reaction. All of a sudden, their cost to get deposits shot up. And when that happens, their ability to lend out money for homes or farms or new small businesses, that goes down. They just couldn't compete with the rates the giant national banks were offering. And sadly, a lot of them either had to merge or just close their doors for good. This quote here, it really just captures the whole feeling on the ground. For a community banker, some rule change made way off in Washington, D.C. had a direct and often painful impact on the families and businesses right there in their own town. All right, let's fast forward to today. That river of money is flowing faster than ever, and a powerful, brand new current is emerging. Digital dollars, and more specifically, things called stablecoins. So to get a sense of just how big this new wave could be, just look at this number. One projection estimated that if these new digital platforms started offering interest on stablecoins, community banks could lose up to $1.3 trillion in deposits. That is a staggering amount of money, potentially flowing out of local economy. And here's what that actually means in the real world. That massive outflow of deposits could slash local lending by an estimated $850 billion. We're talking about fewer mortgages for families, fewer loans for farmers, and fewer entrepreneurs getting the cash they need to get a business off the ground. Now, lawmakers see this coming, and they're trying to build some new guardrails for this digital river. There's a new framework being discussed, nicknamed the Genius Act, and it's trying to bring some stability. It would require these stablecoins to be backed one-to-one with safe assets, set up clear rules for who's in charge, and demand total transparency.
But, and this is a really crucial point, this threat is still mostly a what if. A recent study that looked at years of data found that, so far, stablecoins haven't actually caused a major drain from community banks. The key word in that whole sentence, of course, is yet. We are very much in the early days of this new current. So, after this whole journey through history, policy, and brand new technology, what have we actually learned about where this river of money is headed next?
When you step back, it's really a story in 3 acts. First, we built a dam to create stability. Then, we tore it down to encourage competition, which opened the floodgates and really hurt a lot of local banks. And now, this new digital current promises amazing efficiency, but it also threatens to pull that flow of capital away from Main Street. At the end of the day, where your money goes really, really matters.
And that leaves us with the big trillion-dollar question for the future. As this technology becomes a normal part of our lives, is it going to be a tide that lifts all boats, creating new opportunities for local businesses, or will it become a powerful current that just drains resources away, leaving our neighborhood economies high and dry? The answer to that is going to shape the flow of money for all of us for generations to come.